Hey everyone, and welcome to This Explainer. Today, we are taking a really close, completely objective look at Kenya's proposed Finance Bill 2026. Now, if you've been online or just reading the news lately, you know there is a massive amount of political noise surrounding this legislation. It's everywhere. But we aren't here to play politics today. We're actually here to cut straight through all that noise and look strictly at the math, the actual policies, and the mechanics of what is written down in the bill itself. Specifically, we're zeroing in on two major areas that hit close to home for almost all of us: the taxation of your physical mobile phone and the sweeping new levies on digital financial services.
So here is the million-dollar question we're looking at today. The government is arguing that this bill simplifies the tax code and will actually make physical smartphones cheaper for the everyday consumer. Sounds great, right? But on the flip side, consumer lobbies and industry experts are warning that the cost of actually using that phone, for digital payments, card transactions, online business, is about to go way up. It's this fascinating trade-off between hardware and software, and we're going to break down the facts so you can see exactly how this might impact your wallet.
Okay, here's our roadmap. We're going to cover 1. The 2026 tax uproar. 2. The new mobile activation tax. 3. The hidden VAT trap. 4. Taxing digital money services. And finally 5. Privacy and digital inclusion. Let's get right into it.
Section 1. The 2026 tax uproar.
There has been a lot of public anxiety that our digital lifelines are about to become completely unaffordable. But the Treasury, led by Cabinet Secretary John Mbadi, argues that the public is kind of misunderstanding the math here. They're actually claiming this is a tax reduction strategy. Well, let's look at the reality of our current system. Right now, an imported phone is hit with what I can only describe as a tax avalanche at the port. You've got a 16% VAT, a 10% excise duty, a massive 25% import duty under the East African Community Tariff, plus a 2.5% import declaration fee, and a 2% railway development levy. According to the government, all of these fragmented, layered charges create a cumulative effective tax burden of about 55.5%. That right there is the primary reason why a smartphone often costs significantly more in Nairobi than it does internationally.
So the crucial point the government is making is this. The finance bill proposes wiping away several of those upfront port levies. It completely exempts imported phones from the import declaration fee and the railway development levy. Instead, it collapses the primary taxation into one single, flat 25% usage-based excise duty. Now yes, that is a sharp jump from the previous 10% base excise rate. However, the Treasury argues that overall, dropping from a 55.5% cumulative burden down to the single 25% rate is a massive win for the consumer.
Moving on to Section 2, the mobile activation tax.
So how exactly does the government collect this new 25%? This brings us to one of the most innovative and definitely most controversial mechanisms in the entire bill. When you actually read the text of the legislation, it clearly states that the liability for this duty arises at the time of the activation of the phone. Think about that for a second. The government is shifting away from taxing the phone at the border. Instead, they're taxing at the exact moment it is turned on. It's a strictly usage-based tax point.
This activation model basically builds a completely new life cycle for mobile hardware. Imagine you're an electronics retailer. Under this proposed system, you can import a whole batch of smartphones without paying those massive upfront levies at the port. You can stock your shelves and keep your business capital fluid, instead of having it locked away in unsold inventory gathering dust. You only remit that 25% tax to the KRA once a customer actually buys the phone and activates it on a local telecom network like Safaricom or Airtel. From a pure cash flow perspective, retailers maintain a lot more liquidity, which theoretically means they can price devices more competitively for you and me.
All right, Section 3, the hidden VAT trap.
But of course, tax policy is never quite that simple, is it? While the 25% activation tax seems straightforward enough, we really need to demystify a complication that tax experts are calling the illusion of exemption. See, the bill proposes moving mobile phones from being zero-rated to being exempt from VAT. Now, on the surface, both of those sound pretty great for the consumer, because in both scenarios, you pay 0% VAT at the cash register. But behind the scenes, the difference is literally massive. When a product is zero-rated, the manufacturer can actually claim back the VAT they paid on their raw materials. That's known as input VAT. But when a product is exempt, the manufacturer cannot claim back that input VAT.
And this is a serious trap for local phone assemblers, because the bill removes the imported qualifier for mobile device duties. Locally assembled handsets completely lose their previous tax advantages.
Assemblers are now going to face unrecoverable input VAT on all the components they import to build the phones. And since they can't claim that money back from the government, those costs just become embedded in the production process. Ultimately, where does that cost go? It gets passed right down to the one-enchie. So actually, while the direct sales tax appears to drop, the underlying cost of building the phone is rising.
Section 4. Taxing digital money services.
Okay, now we need to shift our focus from the physical hardware in your hand to the software that powers your daily life. The bill aggressively integrates the digital economy into the formal tax net. Let's start with the good news for the everyday consumer. Basic peer-to-peer mobile money transfers, like, sending standard M-Pesa from your wallet to a family member, those remain tax exempt. Phew. However, the commercial side of the digital economy, that is facing some strict new levies. The bill introduces a standard 16% VAT on commissions and services supplied over digital platforms. That includes payment gateways, merchant acquiring, and aggregation services. And on top of that, card interchange fees are now being roped into withholding tax.
To really understand why this is happening right now, we have to look at how the bill defines royalty and management fees. Recently, the Supreme Court of Kenya ruled in favor of Absa Bank. They stated that interchange fees did not qualify as management or professional fees, and therefore couldn't be hit with withholding tax. Well, in a direct legislative response, the government is basically rewriting the dictionary here. They are expanding the definitions in this bill to explicitly capture digital payment networks, switching systems, and card schemes. This effectively bypasses that court ruling, subjecting these transaction flows to a 5% withholding tax for residents and 20% for non-residents.
And this leads us to the cascading cost of digital taxes. Banks, fintech companies, payment processors, they operate on pretty tight margins. When they are suddenly hit with a 16% VAT on platform services and new withholding taxes on network access, they absolutely are not going to just absorb those costs. They will inevitably pass them downstream. What does that mean for us? It means higher interchange rates and higher merchant service charges, which are ultimately borne by small business owners and the everyday consumer on nearly every single digital transaction they make.
Finally, Section 5. Privacy and digital inclusion. As we zoom out to look at the big macroeconomic picture here, we find a real clash between the government's goals and consumer warnings. Lobby groups like COFEC are raising two major red flags. First, they argue that jumping to a 25% activation tax is just excessive, and that it completely offsets any benefits of VAT exemption, ultimately hurting digital inclusion efforts. But even more critically, there is the whole issue of enforcement. Think about it. To tax a phone at the exact moment of activation, the Kenya Revenue Authority is likely going to need deep data integration with telecom operators like Safaricom and Airtel. This implies real-time monitoring of International Mobile Equipment Identity, or IMEI numbers. Critics are definitely sounding the alarm that this level of tracking could easily infringe on the fundamental privacy rights of citizens.
Which brings us to the ultimate trade-off of the Finance Bill 2026. The government is trying to reorganize import taxes to make physical devices more accessible, but simultaneously, they are tightening the tax net around the very digital services we use those devices for. So the question we all have to ask ourselves as this bill moves forward is this: will theoretically cheaper hardware even matter if the digital economy it connects us to becomes too expensive for the average citizen to actually participate in? Thank you so much for joining me for this explainer, and remember to keep asking the hard questions.